Right now, a structural shift is unfolding inside the global financial system. Quietly, gradually, without headlines, the dollar still dominates global trade, still anchors financial markets, still sits at the center of international finance. And yet, beneath that stability, the foundations of the system are beginning to move. Most people expect change to arrive as a crisis. History shows something very different. The most important transformations begin long before they become visible. By the time the public recognizes the shift, the structure underneath has already changed. Across central banks, global trade networks, and long-term capital flows, subtle adjustments are emerging. Some nations are diversifying reserves, others are building alternative settlement channels. Financial institutions are repositioning exposure. None of these moves appear dramatic in isolation, but structural change rarely announces itself. What makes this moment different is the convergence of pressures: rising global debt, shifting geopolitical alignments, evolving financial infrastructure, changing trade dynamics. Individually manageable, together transformative. The dollar's power has never rested on economics alone. It rests on trust, network effects, and the architecture of global finance. When those foundations remain aligned, the system appears permanent.
When alignment begins to shift, even slightly, the direction of the future begins to change. Most people watch visible signals: markets, inflation, interest rates. But structural change happens deeper, inside the mechanisms connecting money, power, and global incentives. Slow, quiet, consequential. The real question is not whether the dollar system is collapsing. The real question is whether its structure is evolving and what that evolution means. Because once global monetary systems begin to shift, they rarely return to their original form. For decades, the global monetary order has operated on a simple assumption: the dollar is the center, and everything else adjusts around it. Trade flows through it. Reserves accumulate in it. Financial risk is priced through it. Over time, this became so normal that few questioned the mechanics beneath it. But large systems do not change through announcements. They change through incentives. When enough participants begin adjusting behavior, even slightly, the structure itself begins to evolve. In recent years, subtle changes have appeared across multiple layers. Some central banks are reducing concentration risk. Certain trade corridors are experimenting with non-dollar settlement. Payment infrastructure is evolving, quietly, incrementally, systemically. The visible narrative still signals dollar strength, deep liquidity, global trust, institutional depth, all true. Yet beneath that strength, strategic hedging is increasing, not because the system is failing today, but because long-term positioning is shifting. Geopolitics adds another layer. Financial sanctions, regional alliances, and strategic autonomy are reshaping incentives. When currencies intersect with power, behavior changes. Some nations seek resilience, others seek independence. The result is diversification, gradual, not dramatic. Technology is also reshaping financial architecture. Digital settlement rails, cross-border systems, and evolving payment networks reduce friction, and when friction falls, alternatives become easier to explore. What makes structural change difficult to detect is that the old system can continue functioning while it evolves. Markets remain liquid. Trade continues. Stability appears intact. Yet underneath, incentives are recalibrating. The dollar system depends on alignment: financial, economic, geopolitical. When alignment shifts, even slowly, the direction of the structure begins to move. Across modern history, monetary dominance has never been permanent. It has always moved. Slowly, structurally, often unnoticed until the transition was already advanced. Not through sudden collapse, but through shifts in trade, capital, and global influence. Every dominant currency rises through concentration. A nation becomes the center of global trade and finance. Its currency gains trust. Contracts are priced in it. Trade settles through it. Reserves accumulate in it. Over time, using that currency becomes the default, not because it is flawless, but because the network around it is deep, liquid, and trusted. This creates a powerful feedback loop. More trade increases liquidity. More liquidity attracts capital. More capital strengthens markets.
stability reinforces itself. During this phase, dominance appears permanent, but permanence in large systems is often an illusion created by stability. Over long periods, structural pressures begin to accumulate. Economic expansion leads to financial complexity. Debt grows. Global commitments widen. Trade patterns evolve. None of these forces break the system, but together, they begin to change incentives within it. At a certain stage, diversification begins. Quietly at first. Trade partners explore alternatives. Financial centers emerge elsewhere. Capital begins spreading across multiple hubs. The dominant currency remains central, but exclusivity begins to soften. What makes this phase difficult to detect is that dominance continues even while diversification grows. Markets remain liquid. Confidence persists. The system appears stable. But beneath the surface, concentration is slowly decreasing. Historically, once diversification reaches a certain threshold, the global monetary system becomes more complex and less singular. The leading currency often remains dominant, but no longer alone. The key insight is this: monetary transitions are not sudden events. They are long structural processes driven by incentives, networks, and time. They unfold quietly, step by step, often invisible while they are happening. And when viewed in real time, they rarely look like transformation until suddenly they do. When monetary systems change, they rarely announce themselves. There is no single moment, no official declaration, no clear turning point. Instead, transformation begins quietly, while the system still appears stable on the surface. History shows this pattern repeatedly. A dominant monetary center rises, builds trust, attracts global trade, and becomes the foundation of international finance. For a time, the system appears unshakable. But over longer horizons, structural forces begin to shift the balance. In earlier centuries, Spain stood at the center of global wealth, as precious metals flowed from the New World into its economy. Its currency circulated widely, and financial power followed imperial reach. Yet over time, commercial and banking activity gradually moved toward more flexible and dynamic financial centers elsewhere in Europe. Spain remained powerful, but the structure of finance began redistributing beyond its control. Later, the Dutch Republic built one of the most advanced financial systems of its era. Amsterdam became a hub of trade, capital, and credit. The Dutch currency gained international acceptance, supported by innovation and commercial networks. But as global trade expanded and geopolitical competition intensified, financial gravity began drifting again. This time toward London, where scale and industrial expansion created a broader base for monetary leadership. The British pound eventually became the anchor of global finance during the height of Britain's economic and imperial influence. London served as the central node of international capital for generations, yet even this dominance evolved gradually. Industrial competition, global conflict, and shifting economic weight slowly altered the structure of global finance. The pound did not collapse overnight. Instead, the system transitioned toward a new center of gravity across the Atlantic. What these moments share is not sudden breakdown, but progressive transformation. Trade patterns changed. Financial networks expanded beyond a single hub. Capital flowed through multiple centers. Over time, the architecture of the system adjusted. In each case, the dominant currency remained influential long after structural change had begun. Confidence persisted. Markets functioned. Stability appeared intact. Yet beneath the surface, the system was becoming less concentrated, more distributed. Monetary systems are deeply tied to economic scale, financial networks, and geopolitical structure. When those foundations evolve, the monetary architecture evolves with them, not abruptly, but steadily, through accumulated change that only becomes visible when viewed across time. Today, the dollar remains at the center of the global monetary system. It dominates international trade, anchors financial markets, and serves as the primary reserve currency for much of the world. On the surface, the structure appears stable: deep liquidity, strong institutions,
and unmatched financial scale continue to reinforce its position. Yet beneath that stability, subtle adjustments are unfolding across the global landscape. The dollar's strength is rooted in network effects. Global commodities are priced in it. Cross-border finance depends on it. US Treasury markets remain among the deepest and most liquid financial instruments available. These forces create a self-reinforcing system where participation strengthens stability and stability attracts participation. But large systems evolve when incentives change. Across the world, some central banks have modestly diversified their reserve holdings, not abandoning the dollar, but gradually reducing concentration. Certain trade relationships are experimenting with settlement in local currencies. Regional financial corridors are developing infrastructure designed to operate with greater flexibility. None of these changes alone reshapes the system. Together, they signal adaptation. Geopolitics continues to influence monetary behavior. As global power becomes more distributed, financial positioning becomes more strategic. Some nations prioritize resilience. Others seek greater autonomy. Financial sanctions and geopolitical tension have increased the strategic dimension of currency use, encouraging exploration of alternatives without immediate replacement. Technology is introducing another layer of change. Cross-border payment systems, digital financial rails, and evolving settlement mechanisms are expanding how value moves globally. These innovations do not instantly transform the monetary order, but they reduce barriers to diversification. Even small reductions in friction can shift behavior over time. Despite these movements, the dollar remains dominant because large financial systems change slowly. Liquidity, trust, and institutional depth create inertia. Stability reinforces itself, but inertia does not mean immobility. The present landscape reflects a system still central, yet gradually adapting, shaped by shifting incentives, evolving global relationships, and emerging structural pressures that unfold over time, rather than in sudden moments. To understand how change might unfold, it is necessary to look beneath the surface and see how the dollar system actually works. Its strength does not come from a single source, but from a network connecting trade, finance, liquidity, and global trust. At the core is the role of the dollar as the primary medium of international settlement. When countries trade across borders, transactions are often priced and cleared in dollars, even when the United States is not directly involved. This creates continuous global demand for dollar liquidity. Banks hold it, corporations manage risk through it, central banks accumulate it as reserves. Over time, the currency becomes embedded in the infrastructure of global exchange itself. Financial markets reinforce this structure. US Treasury securities serve as one of the foundational assets of the global financial system. They are widely used as reserves, collateral, and reference points for pricing risk. Their depth and liquidity attract global participation, and global participation strengthens their stability. This creates a reinforcing cycle, where confidence and liquidity support each other. Another critical mechanism is network effect. Once a currency becomes deeply integrated into contracts, trade systems, and financial infrastructure, switching away becomes complex and costly. Payment networks, debt markets, and global finance are aligned around the dominant currency. This alignment generates inertia, allowing the system to maintain stability even as alternatives slowly develop. Confidence plays a central role. The dollar system depends not only on economic scale, but on trust in institutional continuity, market depth, and systemic reliability. As long as participants believe the system will function smoothly, the structure reinforces itself. Stability becomes self-sustaining, but incentives drive behavior in large systems. If participants gradually diversify to manage long-term uncertainty, small adjustments accumulate, not as disruption, but as redistribution. Liquidity remains central, yet flows begin to spread across a broader structure. This explains why change in global monetary systems tends to be gradual. The system is vast, interconnected, and reinforced by trust, networks, and institutional depth. When it shifts, it usually does so through accumulated adjustments rather than abrupt transformation. When large financial systems begin to adjust, the most important question is not whether change is occurring, but in which direction the structure is gradually moving. Structural evolution rarely happens in a straight line. It unfolds through phases of adaptation, resistance, and recalibration, shaped by incentives rather than announcements. One clear direction is increasing diversification. Not abandonment, not replacement, but distribution. Some countries are gradually expanding trade relationships beyond traditional monetary channels. Others are building regional financial infrastructure designed to increase flexibility. These developments do not dismantle the existing system, but they introduce optional pathways that did not previously exist. Another direction involves the slow redistribution of economic gravity. Over time, global production, trade flows, and capital formation shift. As new centers of economic weight emerge, financial networks adjust around them. Monetary systems historically follow trade, capital, and economic scale. This process is gradual, often unfolding over decades, but it reshapes the architecture of global finance. Geopolitical dynamics reinforce this direction. Financial systems do not exist outside power structures. Strategic autonomy, resilience, and risk management increasingly influence how nations position themselves financially. When geopolitics intersects with currency systems, diversification becomes strategic rather than purely economic. Technology introduces another layer of change. Cross-border payment rails, digital settlement mechanisms, and evolving financial infrastructure reduce friction in global transactions. Lower friction makes experimentation easier. Over time, even incremental infrastructure changes can shift how value flows across the system. What matters most is that structural change does not require collapse. Systems can evolve while continuing to function. The dollar may remain dominant even as the broader structure becomes more distributed. The transition, if it unfolds, is likely gradual, uneven, and shaped by long-term incentives rather than sudden disruption. The direction, therefore, is not toward immediate replacement, but toward increasing complexity. A system still centered, yet less singular, still dominant, yet more diversified, stable, yet continuously adapting. When large systems evolve, the immediate effects are rarely dramatic. Markets continue operating, trade continues flowing, daily life appears mostly unchanged. Yet, beneath that surface continuity, the environment gradually shifts, influencing outcomes over time rather than in sudden moments. The first real implication is uncertainty, not instability, but variability. When global monetary systems become more distributed and complex, predictability decreases. Financial conditions can move in wider cycles. Capital flows can adjust more dynamically. Stability becomes less about permanence and more about adaptability. For financial markets, gradual diversification within the global system can influence how liquidity moves and how risk spreads. The dominant structure may remain intact, yet internal balance shifts. When systems become less concentrated, shocks may propagate differently, and resilience may depend on broader networks rather than a single center. For policymakers, structural change introduces strategic considerations. Maintaining stability requires balancing domestic priorities with global positioning. Trust, institutional credibility, and financial depth remain essential anchors. When these foundations hold, systems tend to adapt rather than fracture. What often matters most during structural evolution is awareness. Large systems rarely send clear signals in real time. Instead, they shift through many small adjustments, changes in trade behavior, financial positioning, infrastructure, and incentives. Recognizing direction does not require predicting outcomes. It requires understanding how systems move over time. In real terms, structural change reshapes the environment in which decisions are made. The system may appear stable, yet the forces influencing growth, stability, and risk gradually transform beneath the surface. Continuity remains visible. Evolution continues underneath. When systems of this scale evolve, the final realization rarely arrives through a single event. It emerges from seeing the full structure at once. How trade, finance, power, and trust connect into a single architecture. The dollar system did not form overnight, and any transformation within it does not occur overnight either. It unfolds through decades of incentives, networks, and gradual adjustment. The central insight is not collapse, but evolution. The system that has anchored global finance remains powerful because of its depth, liquidity, and institutional foundation. These strengths do not disappear quickly. Yet, strength does not mean immobility. Even the most established structures adapt when the environment around them changes. Across history, monetary systems have shifted when economic gravity, financial networks, and geopolitical alignment evolved together. These transitions were rarely obvious in real time. They became clear only after gradual adjustments accumulated enough to reshape the architecture beneath the surface. Today, continuity and change coexist. The dollar remains central, yet diversification slowly expands. The system continues functioning, yet incentives recalibrate. Stability persists, yet the long-term structure adapts. Understanding this coexistence reveals the true nature of the moment. The deeper question is not whether sudden disruption is imminent, but how large systems evolve while appearing stable, and how small, often unnoticed changes eventually redefine the broader structure. When viewed individually, each shift appears minor. When viewed together, they reveal direction. The system is not standing still. It is moving, slowly, structurally, and continuously, shaped by time, incentives, and interconnected forces. Recognizing that movement provides clarity, and clarity, more than certainty, is what allows observers to understand where history may be quietly unfolding.